right, so we have a very exciting panel for you today. We're going to be exploring myths and exploring different opportunities in the investment world. I'm very happy today to have an amazing panel, which I want to introduce before we start the discussion. Before I do that, I want to let you know that this panel is meant to be interactive. As you heard before in the previous session, we do have an app. It's Estonia, so we have an app for that. It's Votemo. On that app, you can scan the QR code, and you will see a series of statements that I will be asking the panel, and you can then choose which of the answers you want to vote, and we can check the results as the panel evolves. So I invite you to scan that now so that you're ready to vote. We want to make this kind of an engaging two-way panel so everyone can have a little bit of a say. But on the panel today, we have Mike. Mike is an early-stage investor in B2B data-intensive startups, and he has invested in around 40 companies. Currently with Amsterdam-based Acrobat Ventures, he's investing in pre- and seed stage, and he's primarily interested in machine learning and SaaS type of companies. Then we have Siwen, who's an investor at Goldman Sachs growth equity investment platform, based out of London and focused on the opportunities set across Europe and Israel. Siwen primarily focuses on investing in enterprise software, Industry 4.0, and healthcare technology. Then we have Sten. Sten invests in the next legendary tech companies from Europe via his Plural platform. Sten was a co-founder of Teleport, which was acquired by Topia in 2017. At the time, he was an entrepreneur in residence at Anderson Horowitz, and he served at Skype as an early executive for over 8 years, from the early days until its exit to Microsoft. Then we have Mikaela. Mikaela is a partner and head of growth at VNTRS, a Nordic-Baltic venture studio and sweat equity investor that transforms good ideas into great ventures. With their collective knowledge from startup journeys and exits, they hands-on create the best conditions for the startups to succeed. And finally, we have Sebastian, who's a managing partner at Acton Capital, a German growth stage VC fund. Acton invests in tech-enabled companies with a proven sustainable business model in Europe and Canada. And most recently, they led the 12 million euro Series B round of our very own talent-based SaaS company, Klaus. So this panel is all about exploring different myths around VCs. We have different backgrounds from the VC world. We have sweat equity, we have the operator-led, we have more traditional VCs, and we want to have a debate and a discussion about where is the future taking us, what's wrong with the current model, what are the trends, what's the role of AI in all of this. And I want to start with the first statement, and I will invite Sebastian to have a say in that. And the first statement was that the traditional VC model is broken, with too much emphasis placed on unicorn hunting, as maybe we just heard, and quick exits. So is there a need for a new kind of VC model? And if so, how would that look like?
Yeah, I mean, I don't know if it's broken, but at least it has changed a lot over the past years. And we at Acton, we always focused on companies with a sustainable business model. So the question, will it become a unicorn, never been a real question for us. It was more important that you can build a great company with decent resources. And I think what is important to understand is that the last years, it was all about almost capital in abundance. So it was super easy to raise capital. There was a lot of money floating around, companies raising every 6 months at even higher valuations, large financing rounds, probably much more money than they need. But there's a downside to that, something entrepreneurs may not be aware of. Like the traditional VC model in the US is about, you invest in 50 companies, 30 of those go bust. Some are so okay, and hopefully 2 or 3 gonna make it to become the stars. And they're gonna earn back all the money and much more. But by doing so, you have to put in a lot of money to work into young companies and try to make each of them become such a potential winner. But that means that if you raise a lot of funds early on large valuations, the risk profile of your company increases dramatically. Because you're going to hire a lot of people, you will expand the organization much faster than you should do. You won't be able to build a process in the same way. And if it works out, it's great. But if it doesn't, then there's a very hard stop if you're not able to raise funds again, which is happening now with many companies as this whole circle came a bit to a stop. You as a VC, you don't really care because you have 50 of those companies running, and then it just becomes one of the 30 who doesn't make it. But you as an entrepreneur, you just have this one company you build. So I'm a bit warning entrepreneurs in the room that you really think about what size of round you need to raise to build your business. If it's a large round, it's no problem, but think about what you actually need and you can deploy and stage the approach, not to turn the risk of your company to a very high level.
But Sebastian, you're talking from a sort of, traditional VC point of view. So you're kind of, the model might not be broken, it just needs a slightly different approach, right? But Mikaela, your approach is slightly different, right? So how is it that, what is it that you bring to the table, and how do you fit into this evolving world of the VC model?
Yeah, and like first just to comment on the first thing, like for me, not coming from a traditional VC fund, being more of a startup, ex-startup founder and doing sweat equity investments, I think one super important factor here is the consequence of having this mindset. For me at least, it doesn't foster diversity, it does not increase the likelihood for companies to succeed, and you have this narrow lens in just investing in certain type of companies. I would probably not get an investment from you, or any other VC, because people tend to invest in with similar backgrounds, similar personalities. So I think that is the main problem for me, that you have this narrow lens. For us, like looking at the new type of model, I think how we work with VCs, for example, is that we get a lot of leads from them, and they say, this is a really interesting opportunity, this is a really interesting thing, but they are missing X, Y, Z. And then we, as a sweat equity partner, can come in and either help them to get the traction or have that competence so they can become VC ready. That, for me, is a lot better approach.
So that's where you come in. So you try to work together with the existing VCs, and if they have, good deal flow, you'll see, okay, we have guys that can help this company get to the level where the VC wants to put money.
Exactly.
So it's more of a collaboration in that sense. All right. Sten, you guys obviously have a very different approach to the model, right? You wanna, I think it's beyond sweat equity. It's spending actually time with the company. So
yeah. So coming back to your question, is the VC model broken? Absolutely. And the gap that we're seeing is that the interaction model, like something that is very familiar to everybody in the room from Estonia, like it's a very tiny startup scene which has the wave of unicorns of the previous waves, founders and early employees creating and helping the next generation. And that is, which is natural for us here in Estonia, that is not commonplace around Europe at all. Like one shocking thing that we found was that if in the top US VC firms, like about 60% of GPs have actually built and operated companies before, in Europe some stats are as low as 8%. So like 90% of the investors in Europe deploying capital in early stage tech have never built a company before. They come from finance and consulting and all kinds of beautiful backgrounds, but like we believe that there is something specific in the very early stages, and that investor profile changes between a pre-seed and the seed and B and A and pre-IPO. But there is something very specific in these early phases that if you haven't been in those shoes, like there is a certain level of empathy and certain level of experience that it's very, very hard to sort of help the founders with. There's tons of intangible stuff, tons of experience and stories that you can share. And so we started looking at both sides of the market, and there's this interesting thing, especially in Europe, where if you talk to the founders, early stage founders, and ask who was your most useful investor in the previous round, you will always get the name who was not the lead VC. It was one of the angels that gave this important advice at some point, but they had like 10K ticket in the round. And then you go to the most experienced founders around Europe, like you built a $1 billion company, $10 billion company, why having to join the VC fund? They say that product doesn't work for them. Like there is a lot of appreciation for the independence, there is appreciation for, like imagine you built a 10 billion euro company, you take it public, and then you join a boutique VC firm where you go into a room and ask 8 middle-aged men permission to invest. Like that just doesn't fly. I mean, there is this many things, and the VC model hasn't changed that much. If all of us like collectively probably can think of like Y Combinator and Entrepreneur First, and there were some more aggressive models of how to do this differently, but the majority of the thousands of VC firms around the world are still like very boutique-y. They look like a law firm or like an ad agency where there's a hierarchical pyramid and there are like important people at the top and then there is like a back office doing the nitty-gritty and like all of this. So basically with Plural we're trying to build a product for that sort of changing world.
Which is funny because, like you said in the beginning, you're trying to mimic what happened in the Estonian startup ecosystem, right? Which was the builders who were building Skype, they went on to build something else and went on and went on.
It's not unique to Estonia. So our sort of first five people, all experienced operators and CEOs who are investing through Plural. We are right now between Tallinn and London and Paris, and sort of there is a growing network around that. But like keeping the bar really high and building a model where these people can actually go in and do like 2 companies a year, get involved, almost like the last co-founder joining and get really, really hands-on and not do an angel check that they all of used to do, but rather go and deploy more capital and lead around and set the terms. Like that's the product.
All right. Siwen, obviously Goldman Sachs has a very different investment profile than the companies that we talked to before. How do you see you fitting into the picture of the current VC model, where it's leading, and where Goldman Sachs is positioning it itself?
Sure. So we have a growth equity strategy within Goldman. I would say our typical check size is really 25, 30 million above, and with a sweet spot of larger ticket, call it 50 million. So we're coming a lot later than most of the other panelists, borderline, Series B, Series C and above. And for us, the strategy is a little bit different. We oftentimes don't back many horses in the same race, and we oftentimes just back one. So it certainly is not easy to pick, and we asked a lot of questions around this business model, and I think more importantly, doing a lot of digging around sustainability of the unit economic as you kind of climb up the growth curve. And obviously, given the dynamic the other panelists have mentioned, you got a lot of well-funded players in the market, which makes it harder for us to make decisions. And I would say, one thing we always do is just given us as a minority investor in that growth curve is that we are at the end of the day backing capable founders and management team to build a much bigger business. So the most important thing is backing strong founders from my perspective, kind of up and beyond market opportunity, unit economics, and in an environment like this, giving operating support beyond capital is increasingly more important. So we actually do work with a team of 60 operating partners who are providing those as a company's scale. I completely agree with what Sebastian was saying earlier as kind of around the funding dynamics over the last 2 years. And right now, it's getting more difficult to fundraise, especially for a certain kind of stage, I would say more earlier stage. So there is flexibility for us to kind of come in earlier if we believe in the market opportunity, the management team. So there is definitely flexibility for us to come in even earlier.
Every person that I talk to about, at which stage is the funding difficulty there, I get different answers. It's the early stage, it's the later stage. It doesn't seem to correlate with anything. Mike, how do you see, you and Sebastian probably have a similar approach to the market. You come in perhaps a little bit earlier than Sebastian. How do you see you fitting in this evolving landscape of the VC model?
It's a bit similar to a few points that already Sten also mentioned. So I wanted to actually make a different point before I go into this.
Yeah.
And I think when we talk about why VC model is broken, this is also related to fund cycles that are not aligned, especially now with more and more deep tech kind of investors. There you get a problem that if you have a traditional 10-year fund cycle, you don't really manage to do those investments if there's 5 years of R&D with a company. So I think a lot of funds should look more into align the fund cycle, and there's too many traditional funds out there right now.
Which we actually heard from the president at the opening, right? That deep tech is where they want to put a focus, and obviously the investment cycle there is very different from anywhere else.
And certain impact categories face the same problem, right? Yeah. So that's one important thing. Another thing is that I think a lot of successful fund managers that start early stage are very good at it and are able to raise more money, very quickly raise large funds and do something they're not good at. So if you start with a 50 million fund, end up with a 500 million fund or even higher, it's a completely different game.
Yeah.
So you cannot deploy the same way. You have to invest in later stage companies. And I think that's also where a lot of funds break down, unfortunately.
Yeah.
So I think actually the future is way more focused niche funds and smaller funds, right? So that's also our strategy. We don't want to grow above 50 million. We want to stay small, all referral driven.
Where do you see the biggest sort of, you talked about aligning the cycles, right? So
yeah.
what are some of the strategies you can put in place? Because funds typically also they need to answer to someone, right? And there's an expectation on the fund to deliver results.
That's why that expectation needs to be aligned with LPs, right? Yeah. So I mean, sometimes you have evergreen funds, and other times you just have to make clear you need a maybe 15 or 20-year cycle, and you have to have LPs behind it. Similar to impact funds, where you have LPs who buy into a certain strategy, like climate tech, and they don't only care about the return, but also the impact that's done.
Out of curiosity, what's your investment sort of horizon? What's your expected time to get a return? Just quick round.
Typically, a VC fund runs for 10 years, but then you can extend by at least 2, and we have funds that still run year 13 and 14, so we're not forced to sell companies a certain time. We invest typically in late Series A, Series B rounds, so when the company has 2, 3, 4 years of history already. And our average holding period in a company is 7 years, 7 to 8 years.
7 years.
So that means that the exit, in average, then comes after 10 to 11 years of the company being created. But it could be longer. But I think it's an important point that one is the fund cycle, the other is the dynamic of fundraising. So if you have deployed your money, obviously you need to raise a new fund. In order to being able to do so, you need to show some performance, and hopefully not only on paper, but on real assets. And that of course drives funds as well to, especially if they don't have a tradition or a long-term track record, to try to exit companies early on or do a secondary transaction in the next financing round, sell off their share, etc., because this way, early on you can show performance, or you can show your potential investors, actually it's a good investment you're doing.
And this is where the fund and the founder are not aligned.
Yeah.
At that stage.
Yeah. Actually, that's maybe worth explaining to a broader audience. There's this relationship that very often you don't see when you, as a founder, you're raising money from a VC. You think that's this sort of client-service relationship. In the background of that, the VC has a similar relationship with what's called the LPs, the limited partners. And so when these people give you money, they want the particular VC manager to invest that in early stage tech and not hold for too long, because they also want to get the money out and invest in the next fund and build vintages and all of that. And sort of that negotiation and that sort of game and a little bit of a dance that's happened in the background, for me it's super interesting to observe my peers' behavior and my own behavior, because we've all come from a background of investing our own money and reporting to no one, and sort of learning how to respect sort of also the capital markets that you need to raise from. Our first fund is 260 million, so there's pretty big.
Your investment horizon is similar to what?
Formally, our fund is 12 years plus extensions, if we want.
Yeah, Mikaela, for you?
So our model is a bit different. Like, we invest all the way from like pre-seed up to day round, and we invest our own money, so we can basically stay as long as we want. Or, yeah, it depends what's best for the company and for us.
All right. And for Goldman?
So historically, we were deploying Goldman's balance sheet. We actually scaled that business, call it 12 billion AUM or so, and it was more of an evergreen fund because there was no pressure for us to exit at all. And we just raised a new vehicle 2 months ago at 5.2 billion. It's the first external fund, and kind of the average holding period we envision for that fund would be, call it 5 to 10 years, 7 years average.
Wow. It's quite short. Very interesting. All right, let's dig into the second statement that we have, which kind of goes into the topic that we have been discussing here, which is if the ones that have been and done that, do they have an edge? The people that have previously built something, do they have an edge in helping to build the next companies? And I want to turn it over to Sten, which obviously has some experience here.
So what do you guess I'm going to say?
I don't know. You tell me. I think.
So I think one helpful way to think about it is that there is this continuum. There is this 2 girls in an idea phase, where the startup is nothing but an idea and the spark in somebody's eyes, and then there's the IPO that Goldman will run for you. And on that continuum, you will have the pre-seed and the seed and the Series A and Series B. And every time you continue to the next level, basically what happens in the life cycle of a startup is that you de-risk some things and you have a little bit more numbers and quantifiable stuff to prove that your vision is actually coming to life. And so the earlier stage where you have two girls pitching you, then you don't have, like, if they present a spreadsheet, you know that it's made up. Like, everybody can draw a hockey stick. It's a function in Excel if you haven't found it yet. But like in this next, like when you're doing a Series Seed or like a pre-IPO round and deploying like tens and tens of or hundreds of millions of dollars, then you do discounted cash flow analysis and sort of get deep into customer interviews because there are tons of customers that you can talk to. So, and it's obvious that the skill sets for an investor, if you want to help or change the trajectory of the company at these different stages, it's going to be completely different. Like, the closer you get to the IPO, the more you will need to have the corporate finance and investment banking skill set. And in the very, very early stages, there's very little to do with that. If you spend time on Excel sheets, then like you're not progressing your understanding of the company really. So and that's my argument. Is that in that early phase, you need the operating experience.
But I think before, in the previous question, Mikaela raised an important point, which is, you know, in the VC model being broken, there's a little bit of bias that you invest in what you're familiar with. You invest in the companies that you recognize some of you in it. Isn't there also a little bit of bias that comes with the operator model that you end up, you know, investing in companies that you think you can contribute? You invest in people who think like you, and that might actually be a deterrent to some of the diversity that Mikaela brought. So how do you see that?
Interestingly enough, I've seen quite the opposite. With specifically very experienced operators who have built a decade of building a company in this space, it is unlikely that that's the curiosity in life is to continue backing other companies in that space. In that
space. So they want to use their skill set somewhere else.
So as an example, my partner, Ian Hogarth, he founded Songkick. Like, it was a ticketing music business, like a very deep AI component. His academic background is AI. But the last thing he wants to invest in is the music industry now. Like, so he would rather go and do a fusion energy company, or like find a stellar female founder that has been backed by others and sort of find the underdog and try to work with a person where there is impact and there is something interesting and there's something new to learn. And what happens is that when you go to a new domain, very often, like when I work, for example, I have a company that I've invested in the Netherlands, which is a material sciences company. Like, the founders of that company will always know way more than I ever can dream of about inorganic chemistry. Like, they don't need domain expertise. But they are yet to hire the first VP of sales. And I have done that a few times, they haven't. So it's like, that's the company building skills, how to raise the next round, how to build a executive team, how do you manage cultural change. Like, these are the things that we can bring on the table when coming from a different industry. For example, in this deep tech, it's very, very visible that there's very strong academic teams who don't have that skill set, right?
Mike, how do you see it from your perspective? This sort of been there, done that brings an edge, or do you want to back the people that know what they're doing and you want to leave them to get it done?
So I think I partly and mostly agree with Sten, but also partly disagree. And where I disagree is that I see some operator funds that miss the finance background, and that gets you in trouble with fund modeling and fund operations and other things where you just lack the experience. I think that's massively important. So that's one thing where it goes wrong. I think the bias question I've also seen go wrong. I've seen amazing operators turning VCs that just getting very excited by product and invest, where they may, if you look at the market data and the research that should have done, they shouldn't maybe have done that decision. And so I think I'm a big advocate for operator-led VCs, obviously, so I'm definitely in Stan's camp. But I also think that at the end of the day, for a fund, the best is if you have someone who also has massive VC experience on the finance side. It really, really helps because there's so much more to it. But then for the founders to have an operator-led VC who you can call every day, who understands your pain, it's not only the help, but it's also empathy to understand what you go through, to help you those stages, massively important.
Mikaela, you're not operator-led, but there's an element to it, the sweat equity model, right? Where you have someone come in, they work with a company to the point where they're ready, and in exchange you get equity. So how do you navigate this, been there, done that, and the help that you give to the teams, and how do you then navigate stepping out of that role?
So of course, like we at Ventures, for example, we have different experts that, like fintech experts that have done this before. We have health tech experts that have done this before. So of course, I'm a bit biased and think that been there, done that makes it better. I also do agree here that if we look at, like if you build a really successful PropTech company, of course you will be better at investing in PropTech. Like you have the background, you know the pitfalls. But again, looking at a bit more mature companies, I do agree that we need to then have the more finance perspective as well. If we flip it around though, and look from the startup side here, like I think what really gives an edge is being operational. And operational is also kind of a buzzword here. Like operational for me is being there through blood, sweat, and tears and actually helping them and get your hands dirty. Not having a board seat only or doing intros. That's for me an edge.
Makes a lot of sense. Sebastian, how do you see this been there, done that, and an edge that it gives?
Yeah, of course, I have to take it a view as I'm this consultant moved into venture. But doing this for 20 years now, one advantage, of course, is that, I mean, Acton has backed close to 100 companies. So we've seen a lot of different business models, a lot of things that work, that don't work. And building an e-commerce business is totally different from building a SaaS company. So I agree that there's value early stage on for helping you building the team, how to recruit people, how to build a culture. But for us, the value is actually to help companies to get self-sustainable and build the internal processes in a way that actually don't need external help from a VC. So that, of course, helping them to hire the right people. For an example, how to set up a sales organization, how to do an incentivization of their team, how to create a culture that you can train salespeople easily because they tend to churn quite fast. But then being in a position to do it yourself rather than relying on external people, could you please do an intro to that client? Which we could do, of course, but we can intro to maybe 10, 15 clients. They need to build an organization to approach 1,000 clients. And getting up to that next level, and we're a little bit more later stage, so it's a bit different. I think that is important to make sure that the VC is not getting too involved in the daily business. At the end, it's the entrepreneur running the show. We consider ourselves as an active sparring partner. We are always there if there's question. And maybe one last thing is what we try to do, though, is that we bring in external chairmen to the board. Because nothing is worse than a board. We have all the VCs and the founders in there. And basically, the knowledge pool is somewhat limited. So we early on try to bring in external chairmen. That's then typically the person that comes from the industry. Like one of our SaaS companies, we have a former founder of SAP who's in the chair. But he has a different relationship to the founder. So he has a different interest, not like a VC interest nor a founder interest, and can discuss on a different level with the founder, yet bringing the experience, and that is, I think, something we. So
you want to help the companies that you invest with, obviously, because their success is your success, but you don't want to babysit them. It's not a kindergarten, right? So you want to back the ones that know what they're doing and are building something sustainable. I think. Yeah,
as that, it's an active sparring partner. So we give our experience, advice, but at the end of the day, it's the entrepreneur to run the show, and he has to decide what's right or wrong based on all the input he gets, and we can try to help, but it's not us.
Mike, you had something you wanted to...
Just a quick comments on the board, both mentioned. I think there's so many shitty boards out there, and it's really the role of the investor, to add quality. I mean, obviously, way beyond the board, but also the entrepreneur to demand this, Because very often it just turns into a reporting exercise. You sit for 2 hours and it's reporting only, which is a waste of everybody's time. You can just, read the PDF, that's it. So again, massively important.
Yeah, I agree with that 100%.
So as an illustration of how bad the boards are, like in most term sheet negotiations, most of the effort goes on board arguments, the votes only thinking ahead of can this board remove the CEO or not. Like founders don't even consider that on the way there might be something useful happening there. And it's like that's where where is the actual useful conversation? Where is the experienced industry person that actually can help you on the way before that conversation happens?
Siwen, obviously for Goldman, this discussion comes at a later stage. So the capital, you know, the money is the thing. Where does the experience come in? You already mentioned a little bit before that, you know, at later stages it's a different focus. But do you see a point of this been there, done that, and operator-led, you know, strategic advice?
I think operating support is important for every life stage of a business, and there's a lot of capital sitting out there. And when we have conversations with, you know, with founders on new opportunities, and the number one question they care about is beyond capital, what else can you bring onto the table? And we do work with operating partners. It's a rapidly expanding team who are providing that operating support. But I would say the way we operate is we have a candid conversation with the management team and really kind of try to be almost passive but super helpful, but basically kind of have a conversation with the founder and understand what are the topics that they want us to help. So it has to be the other way around.
They don't look at you as just a piggy bank. They look at you that you can actually bring something else to the table other than
Absolutely.
money.
We work with 60+ operating partners who are oftentimes experienced operators with the Fortune 500 companies, and we will bring them in if the CEO, the founder want us to. It's kind of more like, you know, it's not that we tell them, here are the things that we think you should fix, but it's the other way around, that they come to us and say, hey, here are the 3-4 things that we want you to help. And I'll just add one more point to this topic as well. We oftentimes partner with operator-led funds who are at the end of the day bring different set of value onto the table, and we have, you know, many success stories that we together, you know, help the company in different ways and build a successful business. So it's more, from our perspective, more collaborative in that regard.
Very cool. So, you know, I think it has been mentioned, the investment landscape has changed. You know, in the last couple of years, it's been increasingly hard to raise funds. There's a lot of startups here that are probably doing their rounds at the moment. A lot of founders who are talking to VCs, and they're thinking, you know, who should I turn to? What model should I follow? Which advice should I take? So I want to give you the opportunity to kind of build a little bit of a story around what you're doing. At what stage can you come in, and how can the startups benefit from your know-how and also obviously your money? So try to put that in a kind of 2-minute story where you tell us how are you different from whatever else is on the stage. Mike, let's start here.
Yeah, so we go in very early, pre-seed, seed stage, try to be the first investor in. We invest in companies with interesting data angle, so a lot of machine learning AI. We're 4 partners, and 3 of us operators built companies before. We have an AI expert as a partner who's been in the industry for 30 years, CTO of Global Orange for 12 years, and assistant professor of machine learning. So he can go extremely deep in technology. That's actually what a lot of other funds cannot do. So not only understanding what we invest in, but actually helping the founders there. Another partner is a growth marketing expert who not only also founded and sold a company very successfully, but also built its own growth marketing methodology. You know, so very strong in helping companies also scale. And I think that founder support is extremely important. Another thing that I noticed actually is that, you know, with earlier funds, with less portfolio companies, you dedicate more time to the portfolio. So I see like successful funds that have already 100, 200, whatever portfolios, you have and take less time for the founders. And in our case right now, and especially also due to the market, where portfolio companies have more questions and need more time, I mean, we have and take the time. And I think that's cool. Important. If at 11 o'clock you call, someone's going to answer the phone.
All right. Siwen.
Sure. We are a global team of 75 investors across US, Europe, and Asia. We typically invest, I would say, anywhere $25 to $250 million per deal. Is more kind of Series B, Series C, and above. And we invest across a pretty broad spectrum of things: B2B software, industrial tech, health tech, fintech, and consumer. And we want to back ambitious and capable founder team to help them build a category-defining business, and that's the most important criteria for us. And obviously, we ask a lot of questions. We do diggings on unit economics and how that is gonna, you know, kind of evolve over time as a company spend more money and try to climb up the growth curve. But I would say backing strong founders is the most important criteria for us.
Sten?
So at Plural, Plural as a fund doesn't have a thesis. We have some constraints on amount of capital and all of that. Our typical check tends to be 5 million in the first when we enter the company. So we're not quite the right investor for the pre-seeds and the first money, but usually like seed A is our sweet spot. And you should think of Plural so the people investing through Plural have built as CEOs or founders, taken $10 billion companies public, paid off 100 million subordinated debts, reorganized hundreds of people, run product engineering at the 330 million monthly active scale, 150 million lawsuits against incumbents. Like, if you think that you will run into any of those and want to have a sparring partner like we're here, and it's very important, not just with Plural, but I think all the other investors here agree as well, who are doing early stage rather. I think sometimes founders get very hooked on the brand of the fund, but it actually the particular partner, like that's like getting married. It's like somebody who you will have to talk to for the next 10 years, so you better like each other. And so finding that click. So I think very often, like, we get decks submitted to Plural where our ask is that, hey, please look at the people investing on the platform and like who would you actually like to talk to, and like why? What's your match? What's the background? What's the intent? And then the other thing that we do is that, which is surprising that the industry generally doesn't do, is that we discuss the SLA to the founder. So usually term sheets, again, like the investor's engagement usually in term sheets is limited to will there be a board seat or not, or is there an observer position, something very legalese. And we take it to the sort of the level that, okay, what do you actually need? Like, do you need this person on the board? Do you want to have a 24-hour response on WhatsApp? Like, do you want the help with hiring these 2 executives over the next 12 months? Like, let's get this real. Like, let's, instead of a formality, let's talk about the substance of it. And I think these conversations are very, very useful to have early on, because then you actually know if the relationship is working, but also maybe during those conversations you find out that that's not the right investor for you. So it's like you need somebody with a different skill set for the problems that you have.
Why do I feel like, startups generally would look at Goldman as the piggy bank, and they look at you as the firefighter? Like, if something is wrong that needs to be fixed, who are going to call, Ghostbusters?
But I think if you, if you. You okay?
Yeah.
So if you talk to an early stage investor, probably the operator type that you can get on board is the one that also can help you figure out when is the time to go to Goldman to talk about the growth round and how does that work. Because that's a different sort of, like a different stage of the company, different sort of development and different kinds of discussions that you need to have. And having somebody on your side of the table who has done before is also useful.
Yeah. Mikaela?
So, like, at VNTRS, like, our whole mission is basically to increase the likelihood to more companies to succeed. And I think what's important here to mention, it's like, how can we together make more good ideas turn into great ventures? It's not one way or another. We're like an ecosystem that can help each other. So how we operate is that we invest competence instead of capital. We do have like a more traditional VC fund as well, called VEC. But I think how we look at it is that if you are a pre-seed company, for example, and you come to us, then we'll look at the investment case together and say, hey, okay, so what is needed here in order for you to get a higher valuation? It could be either that you need to accelerate on product development. It could be that you need to get your first paying users. And then we go in with a team and help you to achieve that and become like VC ready or go to the next stage. Or it could be a more mature company that needs to go, for example, from seed to A round. Then we can come in with the growth team. And like our whole model, it's built upon that everyone at VNTRS also is part of the startup. So everyone, all our employees, is also investing, which creates this win-win scenario. So that is basically how we operate. And as I said in the beginning as well, it's just the collaboration between the VC and like us as a specific player that is super important. You
must be doing something right, because you're getting a lot of answers on the sweat equity model. So well done there, Sebastian. What about you guys?
I tried to bring up the score in the VC model. Now we invest in late Series A rounds, Series B rounds, typically 5 to 7 million euro, all the way from e-commerce, marketplaces to SaaS businesses. As I said, we consider ourselves being an active sparring partner. So we try to help the entrepreneurs to build the business. But for us, the entrepreneur is, of course, the most important, together with a proven business model. So we want to see a business model that is working, where you actually can earn money. And for us, it's important that, of course, you want to scale your company aggressively, but not for the sake of scaling. So figure out first how your model is working, and when you figure that out, then sky's the limit, and go and grow. And for that, then, you can, of course, raise more and more capital and more rounds, but not the other way around. And I think in the past, you see many companies with no business model, just raising large rounds, going to 20 countries at the same time, and now actually recognizing that their burn rate is just huge. Last valuation has been absurd, and now it's getting very difficult to raise additional funds. So we're a bit more traditional on that end. But having said that, for us, the entrepreneur with the business model is at the core of the thinking.
Sebastian, I have to say your 2 minutes didn't really work, because now you've increased the operator-led answers there. So I think people
I don't know.
are very impressed. We're running almost out of time. There's one last question that I wanted to touch upon, which is AI. And what impact is AI going to bring to the table when it comes to the VCs, to the investment portfolio? Not a lot of time. People can vote and kind of write what they think. But any thoughts on that, Mike?
A lot. I mean, not only to VC, to a lot of companies, but to keep it short, we're using it already now for market research, competitive research. We're building LLMs on our CRM to search things in an easier way, also for a network to be able to find better people, so that we're not only people we work closely with, like our LPs and successful founders that help, but also in a wider network, so that we can find the right people for our companies. So I think increasingly AI is not going to only help to make our job way more effective, but also it's going to take increasingly sourcing and decision-making away. Decision-making is the furthest.
Any other thoughts? Decision-making, analysis?
To be honest, I don't think it's going to take away decision-making. It's in about the people. You invest in people. And for us, it's super important to meet the team. And the team, for us, it's not only the founders, but the broader team that are running the show early on. And that is an integral part of our due diligence. So I think, yes, you can find companies, you can, of course, optimize on crawling databases whatsoever, but at the end, it's about finding the right fit to the team. And as you said, it's as important that the team gets the right fit with you as an investor. So we always encourage as well people doing due diligence on the VCs, obviously. Where AI is important, though, is, first of all, on the company side, almost every company we work with, AI has some component changing things. And the other thing is a question we always ask, what does AI do to the market you're in? Is there a risk that the market where you think it's a great market, a great product, in 5 years from now actually is shrinking because AI takes over a large part of the value proposition you have?
Yeah, I was going to say the same thing. I think we're way more focused on looking at what's the AI impact to the portfolio companies rather than ourselves. In this sort of model where we're not hunting for deals, we're looking for missions for our leads to undertake. Like that's going to be very sort of relationships and human references and that based for a long time. There's one thing where actively have used GPT to date, which is like all our investors are kind of unemployable, and part of being unemployable, only half jokingly, means that you don't writing memos. So it's super useful if you need to explain in 2 paragraphs what that concept means. Like, there's tooling for that now.
And for Goldman, any skills that you guys currently employ that you think AI is going to take over?
I think we are encouraging every portfolio company to look at, investigate in generative AI and what it means to your business model. But I would say, you know, there's a lot of buzz around it, but at the end of the day, the large language model, without going into too much technicalities, there are certain characteristics of their approach that make it more appropriate for certain use cases, but less appropriate for decision making where you don't have margin for error. So there's a constant debate, just what are the use cases that are still defensible, right, given whatever is going on. So it's certainly top of mind for everyone here.
Mikaela?
Yeah, I think like we are more of a sweat equity partner. So of course, like what have ChatGPT, for example, done for a marketers? They do a lot more efficient work, but it doesn't make them employed, I would say. But so I think from like a sweat equity perspective, like I think it's more look at Motherbrain and the Swedish firm EQT. I don't know if you're aware of that initiative. That is super cool how they actually are screening and doing better investments, but it doesn't like, kind of take away or employ people, it just helps them to do better decisions.
Definitely, I urge people to check Mother Brain and see what they're doing. It was very, very insightful when we were preparing this. Thank you so much to the panelists. Thank you for a fruitful discussion. Hope that some of you are a little bit more enlightened about the different models of VC that are out there and where you want to go in the future. Let's give him a big round of applause. Thank you so much.